Hello everyone, I'm Nikhil Mishra from Setu Capital. Today I will be taking you all to the Indian equity investment framework. So let me share a slide with which it will be helpful for me to explain all these things, and for that I have made a basic presentation. So while talking about investing, it is impossible to forget the pioneers of the modern equity investing framework. Who are these? These are Benjamin Graham, Warren Buffett, and Charlie Munger. These are the people who basically gave a structure to the overall equity investing. Previously, equity investing was considered as a as an exercise which was futile and was considered similar to what is in today's parlance gambling. There were multiple reasons for which. Let's not get into that. What were the reasons? Because obviously there were a lot of insider trading and promoter influence. But starting 1930s, after the great recession which occurred, depression which occurred in the 1930s in America, Benjamin Graham, who was a professor at Columbia University, wrote a seminal publication that was called as Security Analysis in 1934, in which he outlined why does a security behave the way it does. Warren Buffett was his student in Columbia, and he was the only student who got A plus from him. And Charlie Munger is the vice chairman of Berkshire Hathaway, which is the investment vehicle through which Warren Buffett invests. Charlie Munger is 6 years older than Warren Buffett, and still he's probably 99 years old right now and still investing. 98, 99 years old. So, what makes these guys unique? So, the first and foremost thing is that success is basically luck in the short term and luck in the short term and skill in the long term. So these guys have a track record spanning more than 60 years, and they also had a selfless attitude towards sharing knowledge, and they gave a structure and explained everything that yes, this is how it happens, this is how an security has to be analyzed. So moving on, so what are the tenets of successful investing? So investing is an exercise, or it's a mental game which most successful investors play with. But there are certain rules of this game. So and a few of the few of them I have tried to outline over there. So the first and foremost would be is a basic understanding that equities over the long period of time generate superior return as compared to any other asset class, whether it is gold, fixed income, or timber, or let's say precious metals, or arts and collectibles. Compounding is also considered as the eighth wonder of the world. Second would be that investment in equity is a patience game. Okay, because it takes time for changes to take place in a business. So does the inherent stock price movement also takes a bit of time in order to showcase those changes in the business. It's basically the stock price is a derivative of the business performance. So stock market generally transfers wealth from impatient to patient investors. Impatient investors are those who generally enter at the wrong time and exit at the wrong time. They are they are generally they panic when there is a downturn, and they become euphoric when there is an upturn in the market. But it should be opposite. One should behave in a contrarian way. Be greedy when others are fearful, and be fearful when others are greedy. Third would be investment returns are not non-linear. Upturns are usually followed by downturns or sideway movements. So in a fixed income, let's say you have a bank FD or any fixed income product. So generally it is understood that if you spend this much amount of time and for this much amount of money, you will be receiving this much amount of dividend. But it doesn't happen in case of equities. In equities, what happens? It may happen. Returns are always non-linear. Non-linear. The trajectory is obviously determined, but the returns are going to be non-linear. There are going to be phases when a stock particularly does not perform for 2 3 years and suddenly gives spectacular returns in the next year, which will simply take away all the underperformance which it had created in the past 2 3 years. So coming on to what are the various investment styles which generate consistent long-term results. So short-term movement are basically uh, driven by simply liquidity. But in long term, it's the fundamentals of the business that drive the underlying security prices. So there are different investment styles. Obviously, there are multiple ways to do to skin a cat. Similarly, there are different investment styles, and all investment styles which are successful have a basis out of them. But not all of them work all the time. The key is to follow an investment style which suits your personality, which suits your temperament, and stick to it. And do not try to digress from it, and do not try to leave it if it doesn't work for some time. You have to patiently persist and continue with the same investment style, and it will certainly give you better results. So the first investment style is called as value investing. So basically, it's a very basic word which is used uh, quite commonly. So value investing is basically investing in companies which are available at relatively low valuations. That may be for multiple reasons. They there might have been It might be because of a slow growth in the industry, might be because of some actions of the government which for a short period of time might have depressed the earnings, but the longer term trajectory of the business is still intact. So in those kinds of situations, uh, generally value investors buy those companies in with an anticipation that the prices will revert to its mean, valuations will revert to its mean. So generally these are unloved opportunities which are mostly in unloved sectors with poor return expectations. So value investing generally requires some sort of a catalyst to work. The catalyst can be formed in the form of reversion to mean of the valuation. It can be in the form of shareholder activism, or let's say a capital reallocation by the promoters of the company. Shareholder activism is particularly difficult in Indian scenario. There, although in the Western world and developed world where the judicial system and the securities laws are much more better defined, in those there are multiple hedge funds which particularly operate in these segments and try to make changes in the organization which subsequently reflect in the stock prices. Value investing, particularly on the bond side or on the fixed income sides, has been completely has it has been completely taken over by bots, or I would say that they have been algorithmic trading which in which algorithms decide whether it should be traded or not. And those have genuinely taken away the arbitrage which was available in other forms of assets, like be it bonds or even to some cases in commodities and other derivatives. So what should be value investing? Since it is an often confused word, so Charlie Munger once and for all has simply stated that all intelligent form of investing is value investing. Who would invest by paying more than what you can get? So it is always better to pay less compared to its original value. So there is a concept of margin of safety involved. Second would be growth investing. So growth investing is quite popular. So it is investing in companies which are in high growth phases. Emphasis lies on the growth delivery and not on valuations. Valuations are not of a paramount importance. It is assumed that the valuations will remain intact if the growth continues. So the crucial factor in this case will be expectation of high growth compensating for elevated valuations. Risk. It has been observed that returns are skewed and for few successes, there are multiple failures. Very few companies keep on growing at steadily at, at higher rates of returns. Most companies show a spark and then subsequently they dwindle. So what is the outlook in the growth investing? It works best in a low interest environment, like it happened in the past 2 years when the capital is cheap. Abundant capital was available and it was simply dumped into the equity markets and asset prices across the world in different forms, whether it is VC or private equity or in our secondary markets. Asset prices did inflate for a momentary period of time. Third would be the momentum GARP and BAAP categories. These are different another forms of styles. Momentum being particularly companies or themes which are currently in vogue and have upward price movement. So the idea is to ride the momentum, and as soon as the momentum loses, you have to get out. Although that's relatively difficult. It in theory it might seem easy, but it's a very difficult thing to get out of momentum companies. GARP and BAP. These are the another two strategies. GARP is one of the most famous and has worked the best in Indian scenario. It is growth at reasonable price. Buying it, what it means is that you are buying growth companies which are present at relatively reasonable price. You are not overpaying for them too much. And one of the another strategy which is called as BAP strategies. Okay. The acronym has been recently coined, but the similar things have happened in the past. So this is basically buy at any price. What it means is that there are certain set of companies which people believe that they will continue performing well. So we can keep on buying them at any particular price, and the valuations don't matter much. But we have seen this in 1950s and 60s in the go-go eras and of sorry, not in the go-go eras, in the Nifty 50 eras of stocks. There were a set of companies which people thought like McDonald's, Xerox. They were very fine companies which people thought will keep on growing. But what happened was is that these companies did grow, but they underperformed for next 10 to 15 years. They were available at such high valuations that people who went into those businesses had to persevere a long duration of 1.5 decades of underperformance vis-a-vis the the index. So what would be my tip? My tip would be to avoid momentum and BAP as they are difficult to execute and years of capital gains can be taken away in a single disastrous year. So we saw the investment styles. Now let's come to investment mistakes. In investing, it is considered that if you are right 2 out of 3 times, then you generally are hitting out of the park. So mistakes will certainly happen, and we have to learn from our investment mistakes. So one of the mistakes would be to chasing past returns and overlooking valuations. So generally, what has worked very well in the past generally underperforms in the future, and one should never overlook valuations. So there have been multiple instances, like in Indian scenario, the dot-com bubble of 1999 and real estate bubble of 2013. So during the dot-com bubble, Wipro and companies like that, Infosys, these companies have had been available at such high valuations that they subsequently underperformed for the next 10 to 15 years. This was quite a stark underperformance, despite the companies, underlying companies were growing at 20-30%. Still the stock price underperformed. And it never reached the peak, which it had attained during the dot-com era. Second would be investing in companies with poor corporate governance and non-minority shareholder-friendly management. So in India, although it is said that management is very important, but in India, management is the most important aspect in investing. So during the 2008, 3 to 2008 era time frame, there were so many capital goods and infra companies which had completely multiplied wealth by 10 to 100 times. But uh, most of the infra companies afterwards went bankrupt because of the poor corporate governance. There are some industries in which the promoters are not shareholder friendly, and that's because the game that's because of the nature of the industry, how it is. So generally it is found that the infra doesn't uh, make money for the retail shareholders. Third would be investing in hot sectors with no fundamental understanding of the business. So if we take for an example the period of 2015 to 2018, it was found that every other promoter of this of this country wanted to create an NBFC of its own. But after the IL&FS crisis, nearly 30-40% of those NBFCs had to either merge with something else or got acquired or went bankrupt or had to at least pare down their own lending book, which they had inflated during the period of 2015 to 2018. So there is a famous fund manager who right now teaches at Columbia, named by Joel Greenblatt. He is famous for his Gotham fund, I guess, if I'm correct. Gotham fund, which was a special situation fund, which used to which gave a return of 50% compounded for a decade. It is one of the best performing funds of the entire documented investing history. So he says that choosing individual stocks without any idea of what you are looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. So we saw the investment mistakes. Now let's come to the winning traits of a particular business. Since as an investor, if you're a good businessman, you will become a good investor. And if you're a good investor, you will become a good businessman. So what are the winning traits of a business? Not all businesses are made in equal, made equal. Some businesses have different characteristics. That's why their operating parameters and financial parameters are also different. So the best businesses are those which have high return on deployed capital and possess a high reinvestment capability. They are the best businesses. The businesses which have high return on capital and have a capability of reinvesting the same capital in their own business. Not all business. In VC parlance, we would call it high return on capital and scalable business. The one businesses which can be scaled. Not all businesses can be scaled. Most businesses, in fact, which have high profit margins cannot be scaled and cannot the same capital cannot be redeployed within the business. It has to be returned to shareholders. And that's why their share price movement generally, although it shoots like a phoenix, but after that it simply stagnates because they don't have any option to deploy capital. Multiple sectors do fall in these categories, like for example, rating agencies or let's say the exchange platforms. These are businesses which have fantastic return on capital, but they don't have the capability to deploy it somewhere else after the initial low hanging fruits have been taken away. So what makes a business better? Uh, Used with the help of competitive advantage or moats. So moats can be in various forms. They can be in terms of barriers to entry. It can be in terms of high switching cost or low cost producing capability. Generally, although these competitive advantages are transitory, and a business has to keep redefining itself and adapt, and innovate in order to maintain its competitive advantage. Then industries or businesses which are in in sectors which have tailwind are more beneficial. So as Warren Buffett says, a management with a reputation of brilliance tackles a business with a reputation of poor economics. It is the reputation of the business that remains intact. So it is extremely important for a business to be in a sector having tailwind rather than headwinds. Example, technology. So currently, if we talk about sectors which are in vogue right now, they although there are multiple secular sectors in India which will consistently keep growing, be it financials or let's say consumer-oriented companies. But the ones which are right now in vogue are basically are multiple, but I have taken few of them over here and tried to outline in order to give a basic idea about these industries. So the first one would be technology, so chemicals, and the third would be health and wellness. So in technology, what are the traits why they are in vogue right now? The first one being is that we have abundant supply of talent available in this country. India is a country where still people are willing to work 10, 11 hours a day, 8 to 10, 11 hours a day. But that's not the case in Europe, or let's say even in other developed countries of North America. There is a wage arbitrage. Then there is digital adoption, which makes the the business communication much more easier. We can India is the India is the basically the back office of the world in terms of the software industry. Although we do have multiple innovative companies in the startup space, but still majority of the sectors, the technology companies which operate in Indian stock market cater to the outside world. Then in due to the pandemic, there has been faster adoption of technology, and every company has to deploy more resources towards technological expansion. Otherwise, they will be left behind and they will lose market share to more technologically advanced competitors. Second would be chemicals. Chemical industry is although a very important industries, but most people don't recognize it because chemicals are generally inputs in other categories of products. Most it's not a consumer facing industry, and it generally is a B2B industry, and that's why it doesn't come into prominence much, but it's a very important industry. And China being the factory of the world used to used to have the largest chemical chemical bulk production. Although after COVID, multiple companies found out that it was very difficult for them to simply depend on a single country, which is China, which can uh, where there was a outbreak of COVID. So subsequently, and then there was a requirement of domestic supplies, which had to be continued, and multiple companies came up in India and started working on import substitutes. So previously as well, China used to take care of all the input materials. They have subsidized raw material, they have subsidized water, they have subsidized air, electricity, just in order to make their own companies competitive. But during COVID, it was involved in the in the control of the epidemic, and subsequently other countries had to companies had to find out some other supplier base. So there can be no other place better than India because we do have a large number of scientists and good chemistry skills in order to in order to supply to these companies as an alternative uh, s- source of products. So there is a China plus one strategy which is going on, and there are multiple companies in terms whether it is in fluorination chemistry or bromination or in phenol chemistry or in enzymes or in other catalysts which are working, and they have had got a shot in the arm after COVID. Then comes the health and wellness. Health and wellness will consist of industries like where there is a lot of potential in our country because it's relatively very underdeveloped or under serviced in terms of health and wellness. Coming on to health and wellness segment, there is pharmaceuticals. Pharmaceuticals are a wide variety of business with completely different business models. So pharmaceuticals, although from an outside point of view, it seems quite simple, but it's a very diverse industries with multiple layers of innovative companies working in it. And the base lies of the generic export where it all started. It is generics, generic medicines, the medicines whose patents have expired, and there are generic medicines available and which are exported. Companies like Sun Pharma, Lupin, Cipla, Dr. Reddy's, etc. So they operate in highly competitive industries. They have very low margin. They are cyclical, and they mainly cater to the US to the developed world. So there is an overcrowded Indian presence in US and developed markets. The peak had happened somewhere in the 2014 and 15. Subsequent to that, in the generic exports, what has happened is there has been a consolidation of the distribution companies in America, which has led to price erosion. Although there is 10 to 20% price erosion every year for generic exports, but price erosion was more rampant because of consolidation of the buyers. Then among pharmaceuticals, there is another category called as branded generics. These are also generics, but these are branded generics. The companies have spent lots of money and they have had to go through a gestation period in order to create brand of their own products. So these branded generics are mainly present in domestic markets and they have high margin. There is a lot of barriers to entry because there is a long gestation period where a particular molecule which is marketed in domestic market had to consistently make losses for the initial period of time because of the marketing cost. So there is barrier to entry. These branded generics are mainly are present in domestic markets and also exported in Latin and African markets, where some companies like Torrent Pharma, Capilin Point Laboratories, etc., are working on. And in domestic case, we have Indoco and others. Then innovators. There are very few innovators, Indian innovator companies. These are very high risk, risky sector in which a lot of patient capital is required, which India being a capital scarce country has a dearth of. Among the health and wellness, there is CDMO and e-pharmacies. So CDMOs are basically contract development and manufacturing organizations. These are the companies which have their own manufacturing facilities and they take and then there are innovator companies which focus on the research and development, have scientists, they focus on the process innovation and they outsource their production part or even for the clinical trials to the contract development manufacturing organizations. So CDMOs are uh, relatively more beneficial and they have a higher margin. Reason being, and first and foremost, why is India better in CDMOs? Relatively because there are competitive advantages. Like cost of hiring a scientist in India is 40%, less than 40% of that in US. So CDMOs, in CDMO, there is a requirement of commitment and secrecy. First and foremost, any innovator company which spends millions and billions of dollars in order to produce a drug won't give the entire process to any random company. It will only give its own process to a company which it believes in. And for that, you need to develop trust with the innovator companies. And developing trust takes a lot of time. There is long gestation period for this. They are relatively they have more margin versus the generic players because they do the difficult work. Coming on to the hospitals and diagnostics. Hospitals, taking the hospitals first. So hospitals in the past has been an underperformer. It might not be the case right now, but historically it has been an underperformer. The basic reason being the government has time and again came and put a price cap on the amount of expenses which can be charged by hospitals. But government had to change everything after the pandemic. What the government understood was that there was a lack of supply of hospital beds, which was acutely visible during the second wave of pandemic, where multiple people died because of lack of availability of uh, hospital beds. There was not much availability because there was not much profit in the business. So creating a hospital and operating it is a very difficult business. It's not easy to run a hospital. First and foremost, there is a large capital expenditure which has to go through. Then there is a gestation period where every hospital has to go through some time frame so that it starts making money. And then there is a journey towards the full capacity utilization. It costs around 80 lakh rupees for a normal bed. Let's say if you're setting up a 100-bed hospital, it takes around 80 crore rupees for a normal bed. If you are thinking of anything like super specialty or multi specialty, in that case, it goes, let's say, for a 100-bed or 250 beds, it will go north of 1,000 crore rupees to set up a super specialty bed hospital. But going forward, things are things are changing in the hospital space, and although if most of the hospitals have also started their own pharmacy business in order to take to diversify their earnings, and also to means because India being a bit underserved in terms of medicine supply. Coming on to diagnostic and e-pharmacies, diagnostics is the has been the darling of the market. Almost every big group with some ambitions is trying to get into the diagnostic space. It's a fantastic business with a very high return on capital. Although it's an operationally heavy business, diagnostic, but it's a very high return on capital business, and high return on capital attracts competition. So it has happened from Ambani's to Tata's to Adani's to everybody, Lupin, everybody is trying to get into the diagnostic space. And earlier it was found that after the entry of Tata 1mg and other venture capital funded companies, it seems like there is a price war going on, which will be beneficial for the customers, at least in the short term. Let's see what happens. But still, the prices which they were asking for, which the incumbent players were asking for before, will not sustain. So this is diagnostics are basically a story of market cost consolidation, where all the mom and pop stores will not be able to compete with large branded players, national branded players. There will be value migration from unorganized to organized retail chains. The use of data analytics will help in gaining more customer traction for diagnostics. E-pharmacies are simply going to chip in away market share for specifically for the chronic segment. It is quite helpful. because there is a lot of stickiness in customer base. Although the cost of acquisition of a customer might be large at the initial moment, but but the 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 discounted value of the lifetime value of a customer, of a chronic ailment customer, particularly for e-pharmacies, uh, is is a lot, and they are taking those into calculations and simultaneously putting in efforts to get more and more chronic ailments. And so these were all the basic guidelines about the hospitals and diagnostics. So these were the sectors in Vogue. So coming on to some international investment opportunities, the whole bucket of international investing can be can be can be divided into three basic areas, which is United States, Greater China means China, Hong Kong, and Taiwan, and the third one being ASEAN and Europe. So United States is obviously the mother of all markets, and there is innovation, investor-friendly jurisdiction, modern monopolies in terms of platform companies. Be it at you take any particular space where there is a lot of innovation, and you will find that most companies come out of America. The 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 Mang companies, the Meta, Amazon, Apple, Netflix, Google's, the video communication, Zoom, every company which is doing some sort of innovation has some or the other way roots available in America. Longest history of wealth creation, United States has. Then let's come to ASEAN, Europe. So ASEAN is although it's a relatively unknown opportunity, not known to most people, but there is a particular region called as Mekong Delta. And we are talking about the regions near Vietnam. There is a lot of value migration going on from China, since the manufacturing and the labor cost in China has increased so much that multiple companies have to transfer their businesses to Vietnam. For example, alone Samsung contributes 20 to 25% of the GDP of Vietnam. So it's an investment friendly jurisdiction, although there are not many uh, direct investment vehicles available, and one has to go through multiple intermediaries to invest in these areas. Then there is the investment friendly jurisdiction of Singapore, Japan, and Indonesia. Japan is relatively it's not growing very fast, so most people don't pay much attention to it. Then in case of Europe, although European region is not growing very fast, but there are certain technological hubs of Europe which are doing certain innovation in the technology sphere, and those are opportunities which could be looked at. Coming on to the elephant in the room, that is China. So China prior to 1 or 2 years was considered a very favorite destination of offshore capital. But after the crackdown which they undertook on their companies, particularly the education companies and the data sensitive companies which got listed into the New York Stock Exchange or Nasdaq, they have completely destroyed their market for foreign investors, because the government intervention into capitalistic market is not considered good from a capitalistic point of view. There are retrograde uh, regressive laws, and there are retrospective laws which are implemented on these companies. Anybody who wants to have an inner understanding of what happens in China should read a book which is called as Red Roulette. Although I do have a book. Yeah, yes, I must be having that book. Just a second. Just a second. You can read this book, and this will certainly give you a great insight about what goes on in China, and you'll be amazed amazed with the involvement of the Chinese um, Communist Party leaders into the capitalistic system which they have, and how they have taken away power and favored somebody and taken away favor from someone. You might not know, and that is not good for us as retail investors who can't do much. We can't go to Chinese ports in order to make changes in the Chinese system, communist system. So for the time being, it's relatively opaque. That brings us to the conclusion of this session. I hope I have added some some tidbits to your investment knowledge, and I wish you all happy investing and thank you. Thank you very much.